Right, this is Bonnie McFarland. Once again, welcome to day 2 of our Institute for this year, Understanding Basic Federal and State Program and Fiscal Laws and Regulations. Perhaps not an exciting and motivating title, but we're glad you're here. We really are happy that you decided to join us. We also, if you didn't join us yesterday, recording is available or will be available as soon as possible, as soon as we get that down. And then we also, the slides for today and yesterday will be in our the link that is posted in the chat. So I hope you will have the resources that you need to support you for either of the 2 days if you missed yesterday. So let's take a look. Oh, joining me today, I forgot to mention, are Rachel Garcia and Adrian Balcazar, who will be addressing several of the topics that we have today. And these are the topics we're going to look at. We're going to talk about federal timelines first, and then we'll look at some cost allocation terminology that's important for both fiscal and program people to have mastered. We'll look at some of the fiscal cornerstones for federal programs, particularly Title I, maintenance of effort, comparability of services, and supplement, not supplant. We'll also take a look at requirements for equipment and contracts, federal cash management, and then finally, we'll take a brief look at federal stimulus funds and some of those requirements. So on the next slide, we're just reminding you, these are some of the resources that we shared yesterday that are available through our publications that might be available to help you. Fiscal Fundamentals has some sample documents in it, and then there's one on time and effort reporting. We also wanted to share one other resource with you, and that's from the California Department of Education. They actually have an excellent guide, and it's on their federal fiscal guidance website, and it's called Federal Grants Fiscal Guidance, and it reviews many of the topics that we here have been talking about the last few days, and it's really up to date, very helpful guide. You can download it. Had a little bit of trouble with that link, but if you don't find it, just put in Federal Grants Fiscal Guidance and you'll get to that page. So that's another resource available to you. All right, before we go ahead, I wanted to follow up from yesterday. We did have one question and we got some additional information. I think it was Jose who asked the question about the reconciliation for time and effort reporting. And we referenced what was in the federal guidance, but we did find, and actually it was in the document that we just looked at, some additional clarification from the California School Accounting Manual. And Jose's question had to do with the timeline for reconciling time and effort reports with the actual reports and the budgeted amounts. And according to CSAM, that if the variance between the budgeted and the total actual costs are 10% or more, then you should be making those adjustments at least quarterly to your fiscal records. But if the variances are less than 10%, then you can wait till the end of the year and true up those numbers at the end of the year. So I hope that's helpful. That was a good question, and just wanted to give you a little bit more detail on that. The other thing we wanted to follow up on, we talked about procurement yesterday, and we also included in the handouts for today this chart from the California Department of Education. They used this during the federal program monitoring, the FPM training this summer. And it gives you a chart, a procurement flow chart that actually walks you through when you need to go to bid, what the definitions are for those various purchases. And it's also based on California requirements, which has a different bid threshold than the feds do. So this is in the handouts for you. We added that today, and it's kind of a handy dandy helpful chart. So I hope that's helpful. Again, today, questions, please put them in the chat. We'll address as many of them as we can today. And also, we'd really appreciate it if you have thoughts for topics or that you'd like to hear about in future meetings. Please enter those and let us know. We're happy to hear your thoughts and respond with any kind of support we can provide. So if you have topics you'd like more about, please put it in there. We'd love to hear from you. All right, so we're going to start out today with federal timelines and for spending federal funds. We're also going to look at some of the challenges in meeting these timelines, particularly this recently with the new Ed Relief Fund. So we'll talk about that a little bit later, but we want to start by just doing a little grounding about federal timelines. So on the next slide, we're going to take a look at the difference between state and federal funds. And federal funds, unlike most state funds, have spending timelines, and they're referred to as the obligation period. So that's the term that's used for the period that a local agency has to spend the funds. Those state programs, most state programs don't have any obligation period. The funds can roll over. However, those state programs that do have timelines are typically special purpose funds that come through legislation, and they're not for ongoing programs. So sometimes you'll have a program that lasts for a number of years, and that's specified in the legislation. So in those cases, state funds may have, do have actually some timelines. Also, beginning this year, LCFF funds had something that's not really a timeline criteria, but they did require that those funds that were budgeted to meet the increased or improved services requirement must be carried over into the following year to serve the same students. So that's not really a timeline requirement, but it is not typical. It is new to LCFF this year, and that was those of you that were working with the LCAP knew that was a challenging piece because some of those funds popped up at the end of the year and you had to adjust them. Also, federal funds have, they do have specific timelines. We mentioned that's an obligation period, and for most federal funds, that is 27 months. Title I is the only program that has a carryover limitation, and that requires local education agencies to spend at least 85% of their funds in the first year of the program. All the other programs you have access to 100% of the funds for the full 27 months. The next slide just kind of gives a visual of this, what the 27-month period looks like. So for your 2021 funds, you received those funds. You may not have actually seen them, but that's the presumption is that they are available to you as of July 1 of 2020. Those would have been available. So then you had 12 months to use those funds. And then you had another 12 months to give you total of 24 months. And how we get to 27 months is that the federal requirement for their timeline is September 30th, as opposed to the state has a June 30th deadline for budget expenditures. The state has a September 30th timeline. So that gives you an extra 3 months, adding up to 27 months. Okay? So that's typical for all your ESSA programs and most federal grant programs. Now, for the last few years, we've had federal flexibility waivers that have extended the timeline for the funds. So we had that for 18-19 and 19-20. So your 19-20 funds are coming to an end this year. Typically, they would have been expired last September, but now they will be available to you until September 30th of this year. So this year you have two pots of money that are ending their obligation period, your 1920 funds and your 2021 funds are both coming to that 27-month period. Question we get, is a waiver on the way? We've heard nothing. We checked with CDE and they don't anticipate any waivers this year for the extension of the funds or for the carryover requirement. Surprises happen. Some of those waivers came in September in the past, but there's nothing that the U.S. Department has to put out a proposal and a request, and then the states have to respond to it. And there's been no request put out from U.S. Department for waivers. So bottom line, you need to check those balances, make those funds get sure they get spent by September 30th. Next slide is, I think, about that is the carryover limit for Title I. And we mentioned that earlier, but you can only carry over not more than 15% of your total allocation. Some people have asked, well, does that include my prior year's carryover? No, it's only the amount that you were allocated for that fiscal year. So for 21-22, you're coming to that point where you have to spend at least 85% of the funds by September 30th or request a waiver. Okay? That waiver is only available to LEAs once every 3 years. And that's because the state is only authorized to provide a waiver once every 3 years. So if you received a waiver in the last 2 years, you would not be eligible for one this year. And the waivers applied for through the consolidated application, but not until the winter submission, which will be generally in February. So that's a little nerve-wracking in a way if you have significant carryover, because actually you're asking for forgiveness because the obligation period has ended. So always best to see if you can get those funds spent. Okay? And again, the reason for that, what are all these rules about? Well, the reason for that is to ensure that this year's money is spent on this year's students, that we aren't just hoarding money to put away for a rainy day. That's not the purpose of the federal funds. It's to help those children that are in school now. So if I'm a 12th grader and don't get support this year from those funds, I lost out. So that's the reason for the carryover waiver on carryover limitation on Title I. The next, I think, just addresses the COVID waivers. Again, this is just a review of that. The COVID waivers that we got actually address two things. They address the carryover. So they allowed the California Department of Education to provide LEAs with a waiver, even if they had received one in the past 2 years. So that was one part of the waiver. The other part allowed you to carry over all your ESSA funds beyond the 27 months. So those are the waivers that were available. And again, those are ending and we don't see any in sight for this year. The next slide. Excuse me, next slide looks at equitable services. And for private schools, the question is, what happens with those? And this is a change from NCLB, but it used to depend on the reason. In other words, in the past, they would say, well, whose fault was it essentially? Did the district not do something to allow the private school to implement services? Or did they not carry out their responsibility to provide the services, the district? Or did the private school not respond in time? That's with ESSA, they changed that and they said now those funds should be used in the current year, and any carryover for equitable services needs to be used for equitable services in the following year. The guidance we referenced earlier also notes that if you exceed the carryover limit for the district, the 15% carryover, and CDE reduces your allocation because of that, that cannot be taken from the amount that you have reserved for equitable services. So another good reason to make sure those funds get spent in time. So let's look at what that means as it gets close to September. This chart becomes very important. We mentioned EDGAR last year, the Education Department General Administrative Regulations. That's where this comes from, Section 75. And this is where the chart is that tells you if you've expended something and when that expenditure counts. This becomes really important as you get close to the end of the obligation period. And we always point out these are different for different kinds of things. For employees, it's when the services are performed. You know, they get paid after that. The check comes later, but if you can count it when the services are performed. For a contractor, or that might be a contractor providing services or a vendor, it's the date on which you make a binding commitment to obtain the services. So if you have a contract in place, then that is considered an obligation because you're obligated to pay it. And you can count that toward the amount that you've spent in that year, and that would reduce your carryover or allow you to not exceed the timeline for spending the funds. Then you typically have 90 days to liquidate the funds, and liquidate means essentially get them out the door. You have to pay the bill. So you have a contract, which is a binding agreement to pay. And then you have to actually pay when within that 90-day period. So that's helpful if you are coming close to your carryover limit, or if you're looking that you might exceed the timeline for spending any of those funds. We did have one on the next slide, I believe. I added a note in here because this is something that we've heard from the Department of Education. I just wanted to put it out there for those of you, and that had to do with federal transferability. As you know, under Title V of ESSA, you're allowed to transfer funds either between Title II and Title IV, or out of either of those programs into Title I and Title III. So that is something that you can't transfer them out of Title I and Title III, but you can transfer into those programs. When you think about that transferability, keep in mind what we talked about yesterday about restricted funds and how restricted funds are. And you can see that Title I and III are your most restrictive funds. So you can transfer into your most restrictive, but not out of your most restrictive programs. And this is documented in the consolidated application in the winter. However, what CDE has informed us is that some districts are under the impression that indicating that in the consolidated application, when they indicate that the funds will be transferred at the state level. That is not the case. Those funds, that's just notifying them that you intend to transfer the funds. But those funds need to be transferred at the district level when the funds arrive at the district. So if you're transferring funds, don't expect that they're going to, if you transferred Title IV to Title I, they will arrive at your district as Title IV funds. Okay, you then have to make that transfer and then document it in the Con App. We mentioned that because there were some districts that were coming to the end of the obligation period for some of their funds, and they thought they'd spent them because they thought they'd been transferred, and they hadn't. So just wanted to mention that while we had a captive audience here to tell you, because that's important, not to lose that money. Okay, so next we want to take just a quick look at cost allocation terminology. We always go over this because these are important for both program and fiscal people to understand, because they have implications for both. So let's just review a couple of those terms. First of all is indirect costs. And indirect costs are those that are not directly allocable to the grant. We talked about being the funds have to be allocable, expenditures have to be allocable, meaning they're directly tied to the grant. Indirect costs are just the opposite. The district has an indirect cost rate, and it's only applied to the actual cost at the end of the year. So when you budget for indirect costs, it's essentially an estimate, assuming that you're going to spend all the funding, but it's only applied at the end of the year. There are some expenditures that aren't included, but they aren't typically things that you're ordering out of your ESSA funds, but you need to be aware of that. There's some capital expenditures and things that can't be counted. The rates for indirect costs change annually, and that's important, and they're posted on the CDE website, and those are up now. It's important for you as a program person to know what your indirect cost rate is and if it's changed from the prior year, because some of the caps on administration include direct and indirect costs. So if those are calculated together, you can see if your indirect cost rate goes up, the amount remaining for you to administer the program goes down. So you need to keep an eye on those indirect cost rates if you're on the program side. Also, a cost, important to know, a cost cannot be counted as an indirect cost and a direct cost. And that's important because you need to know what your office, what your agency considers an indirect cost, because they can't double count. You can't double count it. So if they're saying office space is an indirect cost, then the program can't be charged for office space, because that would be essentially double dipping. Okay, so just make sure you know what your indirect costs are. But that is what the district can take just to absorb those costs. And usually are things you can't see or they aren't tangible. Things like, lights and air conditioning, and it's hard to attribute it to a program. So the feds develop this indirect cost rate process so districts can recover those costs. Okay, but you can't count them doubly. All right. Next is administrative costs. Administrative costs are just those costs associated with administration of the program that are not direct services. And we'll take a look at direct services in a minute. And many federal programs have an administrative cost cap. They say you can only spend so much for administration because the intent of the program is to serve students. For some programs, the administrative cost cap includes both direct administration and indirect costs, and others, they separate them. So you need to know the difference when you look at administrative costs. It used to be very simple, but now that could mean just your direct administration, the work you folks do, or it can include your indirect cost rate. So that administrative costs and those need to be also, we talked about time and effort reporting. Administrative costs are a separate cost objective because you have to track them separately. Direct costs, on the other hand, on the next slide, are those that are attributed directly to the program. Okay, they can be administrative or they can be direct services. But a direct cost is cost we talked about yesterday that would be allocable. Movement said allocable means it directly supports the program. Well, that's what a direct cost is. Whether it's administration or it's student services, I can show this has a direct impact on the program and it's directly supporting that program. There's a connection. So those are direct costs. There is a caveat, and this was in the new revised Uniform Grants Guidance and Code of Federal Regulations. This is the section that's important to note because this was a significant change in the definition of administrative costs and particularly addressing administrative and clerical costs. And according to the grants guidance, direct charging of these costs should typically be counted as an indirect cost. They're saying if you're administering the program or you have clerical staff supporting the program, typically that would be an indirect cost. And that's not what a lot of administrative costs are. They're usually tied to the program. But they say you can direct charge those costs only if all the following conditions are in place. So first, you have to demonstrate that the administrative and clerical services are integral to a project or activity. So you have to show that your work is integral to that program at your schools. The other, that the individuals involved can be specifically identified with that project or activity. So you can show how that clerical staff is specifically working with that program and supporting that program. And they need to be specifically included in your budget. So you need to show where those individuals are in the budget and that they are not recovered as an indirect cost too. So again, you can't double dip. So just know that a bit of a tightening with respect to administrative and clerical costs. They're saying we really need to show it's a directly connected to the program. So you can expect that when you get reviewed, that those will be a little bit tighter in terms of what they're asking for as documentation. Direct services is next, and this is about students, really. It's a service where the pupil is the direct recipient or beneficiary of the service. And this has been interpreted to include professional development and parent engagement in terms of that being the student being the beneficiary of the service. But those are the kinds of things that typically take place at school sites and directly support students. So you can see that that's a little different than a direct administrative cost. This is a direct service. So, and that's important to know because, for example, Title I has an 85% requirement to spend on direct services. Next is something people think this is a federal rule, but it's really California that put a limit on Title I. And it was in regulations, and now they've moved it over into Ed Code. And that is that you can use, the schools can use no less than 85% of their apportionment on direct services and up to 15% for administration costs. So just to note, this is not a federal requirement, but it is a state requirement. And yesterday, as we noted, the state can put additional requirements on your federal awards, and this is one of them. Finally, wanted to take a look at centralized services. And a centralized services, they may be direct or administrative in nature, but usually this is used, usually it's Title I where you see this, because Title I has school level, it's primarily a school level program. So centralized services is a service that's provided by the district or the LEA to the school. And it could be provided in a couple ways, but it's important to note the difference in how you provide it. It could be taken out of a reservation. So you may provide a centralized service. You may say, we're going to have a Title I reservation and for an activity at Title I schools, but it's going to come from the district office. You take that off the top of the allocation before you send the money out to the schools. On the other hand, a centralized service can be taken from the amount that's allocated to the schools. So you allocate the funds out to the school, and then typically it happens, a school site may say, gee, we'd really like to do this or that service or have some resource teachers or something, but we don't have enough money. And school B says, we'd like that too. And so what you can do is provide that as a centralized service. Typically, TOSAs are often centralized. But in that case, if it comes from the school's the school's allocation, then it needs to be included in the school plan and approved by the school site council. So you can see the difference. If it's a district reservation, it comes off the top. That doesn't require school site council approval. If you allocate the funds to the school, then essentially they're saying that we are sending it back to the district so you can provide these services to us. So it has to be documented in the school plan and also approved by your school site council. So that's just a few terms that will come up in your program that impact both program and fiscal people. So now I'm going to turn it over to Rachel, who's going to take a look at the cornerstones for Title I. Rachel?
Thank you, Bonnie. Good afternoon, everyone. So in this next section, we'll be taking a look at maintenance of effort, comparability, and supplement not supplant requirements. And these three fiscal requirements have historically formed the basis for federal education programs and are referred to as the cornerstones of Title I. Both maintenance of effort and supplement not supplant apply to other federal programs. However, only Title I includes a comparability requirement. And so taken together, they mean that districts must maintain state and local effort, provide services with state and local funds that are at least comparable to those provided to schools not receiving those funds, and use federal funds to supplement, not supplant, non-federal funds otherwise available from state and local sources. So maintenance of effort, it's a district level determination that's made annually by the CDE at the end of the fiscal year. And so the purpose is to ensure that states and districts maintain the level of fiscal effort in supporting education programs from year to year and not lower the local or state level of support as a result of receiving federal funds. So maintenance of effort applies to multiple federal programs, but it's applied somewhat differently depending on the program. So for ESSA programs, the state agency must demonstrate that either the combined fiscal effort per student or the aggregate expenditures of the LEA from state and local funds in the preceding year was not less than 90% of that for the second preceding fiscal year. If the LEA fails to meet that minimum level in a given fiscal year, and for one or more of the 5 immediately preceding fiscal years, then all ESSA program funds must be reduced in the same proportion to which the LEA failed to meet that 90% requirement. So again, as mentioned, LEAs are not required to calculate maintenance of effort. This is something that's calculated by the CDE annually at the end of the year. However, it's important to note that LEAs should be monitoring significant reductions in expenditures of state and local funds and alert leadership to possible reductions in federal funding amounts in the subsequent years. Okay, so next we're going to take a look at Title I, Part A, Comparability of Services. So LEAs receiving Title I, Part A funds must demonstrate that all schools are providing comparable services using state and local funds. And this is also a prerequisite for receiving Title I, Part A funds. The purpose of comparability is to ensure that LEAs provide at least the same amount of funding to schools receiving Title I funds as they do to non-Title I schools. So comparability calculations, they must be completed by the district annually and also in a timely manner to ensure that all schools are in a comparable position. Also to allow the district to make any necessary adjustments with the least amount of disruption, and also to avoid the loss of Title I Part A funding. To meet comparability requirements, LEAs must file a written assurance with the state educational agency, and also develop procedures for compliance with comparability requirements, and maintain records demonstrating that comparability of services calculations are conducted on an annual basis. And lastly, LEAs must confirm that the student to full-time equivalent teacher ratios fall within a reasonable variance. And in California, this has been determined to be a 30% variance. So the written assurance that LEAs must file with the state agency assures that the LEA has established and implemented an LEA-wide salary schedule, also a policy to ensure equivalence among schools in teachers, administrators, and other staff, and a policy to ensure equivalence among schools in the provision of curriculum materials and instructional supplies. And LEAs assure compliance with these assurances through completion and submission of the certification of assurances form in the spring CONAP. And so at the bottom of the slide, you can see a screenshot of all of the legal assurances that are included in the CONAP, as well as a screenshot of the comparability assurances. So LEAs must use student enrollment to full-time equivalent teacher ratios to determine whether schools are comparable in one of two ways. So the first way would be by comparing all schools within the LEA as a whole, or by comparing all schools within the LEA by each grade span group. And again, as noted previously, the student to full-time equivalent teacher ratios must fall within a 30% variance. So the CDE has developed calculation forms to assist LEAs with this process and to provide LEAs with immediate information on whether or not a school meets comparability. And again, LEAs receiving Title I funds are required to complete these calculations each year. The instructions and calculation forms, as well as other resources and information related to comparability, can be accessed on the CDE website at the link provided on the slide. And so here we see a screenshot of one of the comparability forms. And so the calculation forms are in Excel format, and they're based on the option that the LEA selects for determining comparability. So again, it's either LEA-wide or by grade span group. And the screenshot included on the slide is the form for calculating comparability by the LEA-wide average. So at the top of the form, you would enter the fiscal year, the LEA CDS code, and the LEA name. And then below that, you would enter the following information for each school. So that would include the school name, the school type, the grade span group code, student enrollment, and also total full-time equivalent teachers. The last two columns in the screenshot, so they're titled student to teacher ratio and is the school comparable, those fields will be automatically calculated based on the student enrollment and the FTE teacher information that's entered. And the last column will indicate whether or not the school is comparable. And if you calculate comparability based on one method, so for example, the LEA-wide average, and find that a school is not comparable, it's recommended that you try the other option, so the grade span group average, to determine comparability. And it's important to note that LEAs must make adjustments in schools that are not comparable. So if after trying both options, a school is still not comparable, then the LEA would need to make adjustments to meet the comparability requirements. And one other important thing to remember is that the student enrollment data and full-time equivalent teacher data must be captured on the same date for every school within the LEA. So you'll want to be sure to maintain documentation that this data is captured on the same date. So here's an example of a completed comparability form based on the LEA-wide average. So in this example, you can see that elementary school C and middle school A are not comparable. So if you look at that last column, that column indicates whether or not the school is comparable. So you can see that both of those schools show a no. So in this case, you would try the other option to calculate comparability, which is by grade span group average. And as I mentioned, the calculation forms are an Excel format. And so the nice thing is that once you complete the information in the LEA-wide average tab, it will automatically populate the data for you into the grade span group tab. So you don't have to enter it again. So here we see an example using the same schools that were shown in the previous slide, but this example is based on the grade span group average. So the first screenshot shows the elementary grade span group, and the second screenshot shows the middle school grade span group. And so you can see that by using the grade span group average calculation, all of the schools in both grade span groups are now comparable. So if you look at that last column in both of those forms, they all have a yes now. So in this example, it worked out using the grade span group option. However, if after trying both options, a school is still not comparable, then the LEA would need to make adjustments to meet comparability requirements. So there are several exclusions when determining comparability. So first off, LEAs do not need to include unpredictable changes in student enrollment or personnel assignments that occur after the beginning of the school year. Also, LEAs may exclude schools that have 200 or fewer students. And if there is only one school for each grade span group, or only one school within the LEA, then the comparability requirement does not apply. And then lastly, LEAs may also exclude state or local funds expended for language instruction programs and the excess cost of providing services to students with disabilities. Additionally, there are several school types that are exempt from meeting Title I comparability requirements. And so these include alternative schools of choice, continuation high schools, county community schools, district community day schools, juvenile court schools, opportunity schools, public special education schools, and also youth authority schools. So LEAs should establish a timeline to determine comparability. An early determination of comparability allows the LEA to make adjustments with the least amount of disruption. The CDE recommends that LEAs complete comparability calculations and also make any necessary adjustments in staffing by October 31st of each year. And there's a screenshot of a sample timeline that has been developed by the CDE to use when determining comparability. And this timeline can be accessed on their website at the link provided on the slide. So as mentioned, LEAs must develop procedures for compliance with comparability requirements. Procedures should be in writing and should include the LEA's timeline for demonstrating comparability, as well as the measure and process used. And also the procedures should describe how and when adjustments are made in schools that are not comparable. LEAs must also maintain documentation to support the comparability calculations, as well as any documentation demonstrating that adjustments were made to staffing to ensure comparability. And documentation is required to be maintained for 3 years after the completion of the activity for which funds were used. However, we recommend maintaining documentation for 5 years. So if your LEA receives Title I Part A funds, it will be important to verify that the LEA has the policies indicated in the assurances and has written procedures for calculating comparability. It will also be important to verify that the LEA calculates comparability annually and makes the necessary adjustments if comparability is not met. And again, maintains documentation of these calculations and any adjustments made. It's also important to note that comparability requirements are monitored through the FPM process, specifically in Compensatory Education Item 13. And evidence requests for this item include the completed LEA comparability calculation forms, the current LEA-wide salary schedule, the LEA's policies to ensure equivalence among schools and teachers, administrators, and other staff, and also the policy to ensure equivalence among schools in the provision of curriculum materials and instructional supplies. And then also evidence of local governing board approval of the comparability policy. So just a few important reminders regarding comparability. So next, for supplement, not supplant. So all ESSA federal programs have a supplement, not supplant requirement. And so in general, the supplement, not supplant requirement means that an LEA may use federal funds only to supplement and increase the level of funds that are available for the education of students. And in no case may federal funds be used to supplant or take the place of funds from non-federal sources. So under ESSA, the test for compliance with the supplement, not supplant provision changed for Title I Part A, but it remains the same for all other ESSA programs. So again, as mentioned on the previous slide, the supplement, not supplant compliance test for Title I Part A changed under ESSA, and it's much different than in the past. Previously, LEAs had to ensure cost past a set of presumptions of what the LEA would have provided in the absence of Title I funds. And so under ESSA, these presumptions no longer apply to Title I Part A. Now, LEAs must demonstrate that the methodology used to allocate state and local funds to each school receiving Title I funds ensures that such school receives all of the state and local funds it would otherwise receive if the school were not receiving Title I funds. And so an LEA receiving Title I funds must ensure this determination is met for both school level expenditures and LEA level expenditures. To determine school level expenditures meet the supplement not supplant requirements, the LEA must be able to demonstrate that each Title I school is allocated all of the state and local funds it would be entitled to if it were not receiving Title I funds. So in other words, the LEA's methodology must be Title I neutral, meaning that it does not take the school's Title I student status into account, and thus does not reduce state and local funds to a Title I school when allocating funds. It's up to the LEA to determine what methodology to use when allocating state and local funds to schools, as long as that methodology is Title I neutral. And LEAs must also meet the supplement not supplant methodology determination with regards to LEA level expenditures. So when an LEA is planning to expend or obligate state and local funds and Title I funds on an LEA-wide initiative, the LEA must look at the funding it intends to use and then determine whether the Title I schools will receive their equal share of non-federal funds. So for example, if an LEA is implementing an intervention program across the district and using state funds to fund the program in non-Title I schools, and Title I funds to fund the program in Title I schools, this would be a supplement not supplant violation because the LEA is not providing state funds to the Title I schools on the same basis as non-Title I schools. So essentially, the LEA must make sure that the non-federal funds are neutrally distributed, and then the Title I funds are used for supplementary purposes for the Title I schools. So here is one example of a methodology based on student characteristics. So this example allocates state and local funds to schools based on a standard formula through which an LEA allocates dollar amounts based on objective student characteristics. So in this example, there are varying per pupil allocations based on the characteristics of students in each school, including a base allocation per student, and then additional funding per low-income student, English learner, student with disability, and preschool student. This methodology would meet the supplement not supplant requirement for Title I because it does not take a school's Title I status into account. So here we see another example of a methodology, and this one is based on personnel and non-personnel cost. So this example allocates state and local funds to schools based on the average LEA-wide salary for each category of school personnel, such as principals, librarians, school counselors, and teachers, and the average LEA-wide per pupil expenditure for non-personnel resources, such as instructional materials and supplies. And so again, this would meet the supplement not supplant methodology because it does not take the school's Title I status into account. And so these are just a few examples of methodologies that would meet the supplement not supplant requirement. Again, since each example is neutral as to whether a school is a Title I school. But again, there are other options to use, and it's up to the LEA to determine what methodology to use. Titles 2, 3, and 4 all contain supplement not supplant provisions under ESSA. However, there are differences in how those requirements apply. So in general, federal funds may not be used to supplant non-federal funds that would otherwise be used for activities authorized under the specific program. It's also important to note that Title III has a higher threshold to meet the supplement, not supplant requirements, because it requires that the program funds supplement not only state and local funds, but also other federal funds. So essentially, the supplanting analysis asks, what would have happened in the absence of federal funds? If in the absence of receiving any funding under a given federal program, the LEA would still have paid for the textbook, computer, or salary in question using non-federal funds, then it would be a supplanting violation to use the federal funding to pay for this expenditure. Remember, federal funds are intended to provide something extra. So for most federal programs, including Titles 2, 3, and 4, auditors presume that supplanting has occurred based on 3 tests. So for the first test, auditors presume that supplanting has occurred if the LEA used federal funds to provide services that the LEA was required to make available under other federal, state, or local laws. The second test presumes supplanting has occurred if the LEA used federal funds to provide services that the LEA provided with non-federal funds in the prior year. And remember, for Title III, this also includes other federal funds in addition to non-federal funds. And then the third test presumes supplanting has occurred if the LEA used federal funds to provide services for participating children that the LEA provided with non-federal funds for non-participating children. And just a note for this presumption, the OMB compliance supplement references only the migrant education program. However, the US Department of Ed uses this test as a basis to presume supplanting as well. And so it may be possible to rebut these presumptions if the LEA can provide documentation to demonstrate that it would not have been able to provide those services if federal funds had not been available. So such documentation might include local board action, budget history, or planning documents. However, it's also important to note that it would be very difficult to rebut the first presumption because you likely can't show that you wouldn't have done what was legally required. And so just as a final reminder, the supplement not supplant requirements are also monitored through the FPM process. And so here we've included a few screenshots for some of the programs for which it is monitored. And so the program instruments provide examples of evidence request and documentation that should be maintained for these specific items in each of these programs. And that concludes my section, so I will now turn it over to Adrian.
Before we move on, just wanted to mention, some of you might have wondered when Rachel said that you submit an assurance to that. Like you might be saying, well, I don't remember submitting an assurance. Where those assurances are in your consolidated application. There is a whole section that is comparability that you agreed to when you submit the CONAP. And then supplement, not supplant, is also found in 2 places in the general assurances where it says when federal funds are made available, they'll be used to supplement the amount of state and local funds that would, in the absence of such federal funds, be made available for the uses specified in the state plan and in no case supplant state or local funds. And it also says personnel contracts, materials, supplies, and equipment purchased with consolidated program funds, that would be Title 1, 2, 3, and 4, supplement the basic educational program. So that's where those assurances are, and your district agreed to those. The authorized representative had to sign off on those. So just in case you're wondering, where are those assurances? Just thought I'd relieve you that they did go through the CONAP. Okay, Adrienne?
Thank you, Bonnie, and thank you, Rachel. So we're going to take a look at part of your procurement and inventory system is looking at how do you keep track of equipment, materials, as well as contracts. Within your equipment control system, all equipment that is purchased with federal funds needs to be inventoried and labeled with purchasing information. So this might include the funding source, the identification code, for example, a serial number if you assign a specific serial number to it, and the name of the district and the school. And then you must also ensure that there are procedures in place to guard against any loss of equipment and materials. So this is a sample here indicating the components of that's placed on the label, including the name, the school name, the program it was purchased from, the purchase date, the delivery date, the serial number, and a salvage date, if indeed it has been disposed. The Uniform Grant Code guidance states that all non-consumable equipment and supplies must be accounted for if they exceed $500 in value and have a useful life of 1 year or more. An additional aspect to your equipment inventory system is regarding items that are less than $500. And it's worth mentioning because many of the items purchased are less than $500. But they, in the Uniform Grant Guidance, this identifies this as computing devices. So what is your policy and procedure to monitor these computing devices? How does your LEA account for small and attractive new technology that may cost less than $500 and can easily walk away? What is your system to prevent theft and loss? A suggestion may be to include these on an inventory list as well. Many districts use a separate inventory to account for these items so that you can prevent theft and loss in a systemic way. Evidence is required, as Rachel said, for in the FPM instruments. And during an FPM for the LEA's equipment, there is equipment inventory items in many of the FPM instruments. It's monitored as part of the Title 1, 2, 3, 4, and even now the Federal Stimulus Monitoring Program instrument includes an item that specifies documentation for the equipment inventory. In the compensatory education instrument here, this is 15.0, it states that the LEA spending Title I Part A funding on equipment shall maintain a historical inventory record for each piece of equipment with an acquisition cost of $500 or more per unit. So a note to point out is the word in 15.01 historical, which means the inventory record must contain the history of the equipment inventory to show that it is ongoing and it is showing the useful life of the equipment. The CE item listed here are all the components that should be included in your equipment inventory list. They now have A through M. You know, this list keeps growing. And so it's important to look as you go back to school and you're starting the school to have the conversation with your procurement or whoever maintains the equipment inventory list for the whole district to make sure that these additional components that were added a couple years ago, but commonly are found in non-compliance during FPM reviews this past year as well as the year before. So what was added was F, who holds the title, I, the percentage of federal participation in the project cost for the federal award under which the property was acquired. Now you not only have to give the current condition, but the actual use. And the last one, any ultimate disposition data, including the date and the sale price or the method that was used to calculate that current fair market value. So these are additional things that must be included in your equipment inventory list. So again, you want to start at the beginning so that you can make sure that your procurement and your logistics and everyone else that is handling this, that they all have the current most up-to-date data. The next part of this item is 15.1. This addresses capital expenditures. So the purchase of capital expenditures for special purpose equipment must have the prior written approval from CDE for items that are a unit cost of $5,000 or more. And so evidence would be showing the proof and the written approval from CDE granting the allowability to purchase this particular unit over $5,000. And then 15.2, this has been revised from last year's, and this addresses the disposition of the equipment that is on your equipment inventory list. So for disposition of equipment purchased with Title I Part A funds with a fair market value in excess of $5,000, it may be retained by the non-federal entity or sold at a percentage of the current market value, and with the proceeds going to the feds. The second part of that is for disposition of equipment that's less than $5,000. It can be disposed without any obligation to the state educational agency, which is CDE. And then the last component of CE 15 is 15.3. It states that the LEA must conduct a physical inventory of the property, and the results must be reconciled with the property records at least once every 2 years. So here are some key points to keep in mind in regards to your equipment inventory. Remember, you must conduct a physical inventory of your equipment at least once every 2 years. You must reconcile the results of that physical inventory to your official district equipment inventory list and complete any necessary follow-up. If items are missing because they were stolen, this must be recorded in a police report or in a letter to the police describing the items and giving their identification numbers. And again, that's why it's important that all your equipment is tagged. And lastly, the historical inventory list of all equipment purchased for $500 or more require that copies must be maintained at the district level as well as at the school level, so that there is alignment and agreement between all the records that are historical. So what's in place in your district's internal control system to prevent loss, damage, or theft? How do you determine if equipment is needed for the implementation of your program? How do you know if other unused equipment is available? Perhaps you might check in the closet. Sometimes there's a lot of unopened boxes. How do you ensure that equipment purchased with federal funds is used only for the authorized purpose? And that sometimes is a very challenging task because people sometimes don't understand the purpose of the federal program, and therefore they think it's can be used for any purpose. So remember, if equipment is lost, damaged, or stolen, you must investigate and you must document. Let's take a quick look at contracts. Just to reiterate what Bonnie shared yesterday about contracts and controls, what controls do you have in place for contracts? Who reconciles if the services have been rendered as stated in the contract? Who's responsible to check this? And within your contract itself, your contract must clearly delineate what services are to be performed or goods to be delivered. Is the date when services will be or when the goods will be delivered included in this? The location where services will be performed or the goods delivered, and the number of students, teachers, etc., that are to be served by this. Another fiscal component of your federal programs is the cash management system. The cash management data collections is a web-based cash management data collection system that is usually done in the fiscal office. LEAs submit quarterly the balances of the federal program funds under Titles 1, 2, 3, and 4 of ESSA. And the purpose is to minimize the time between the receipt of federal funds and the disbursement of funds by the LEAs. This was put in place in response to findings that LEAs were not spending the funds in a timely manner. So now the federal law has a drawdown requirement that limits the time that LEAs can hold on to the funds that are withdrawn from the federal treasury. The reason for the cash management system is important because the LEAs will not receive apportionments if they are not spending at least 25% of the funds each quarter. The system will not affect your calculated entitlement. It will just affect only how much you will receive each quarter throughout the school year. So basically, you'll still receive the funds, but it will be delayed. Interest on federal funds is also connected to the cash management reporting. LEAs are required to report interest earned on federal programs to CDE quarterly. LEAs are allowed to keep up to $500 of interest earned per year for administrative purposes. But keep in mind that the $500 is based on the total of all federal funds received by the district, not $500 per program. So this amount would inform CDE that of the amount earned or the interest earned of unspent program advances. And for more information and steps for calculating interest, you can follow the link we have provided here. So some things to consider about cash management reporting and interest are, how are your program staff tracking the spending? At the district level, at the school site level, who in your business office is doing the cash management data collection reporting? Who ensures that the cash management reports are completed and they're accurate? Who is checking to make sure apportionments are coming on time? And also communication systems. What communication systems are in place to ensure that program and fiscal staff are in communication regarding the cash flow and expenditures? District and school level staff are communicating regarding expenditure timelines. Are they making sure that they're both on the same page? So once again, communication between program and fiscal is key. And now Bonnie will continue with the federal stimulus funds.
Thanks, Adrienne. We wanted to take just a brief look at federal stimulus funds. We've spent a lot of time in the past looking at allowable uses and such, but some issues have come up recently about the funds that we want to take a look at here. So on the next slide is just the chart that we looked at yesterday that shows all the different funding sources. And what we are looking at is basically the level of restriction in the funds. And you can see we had LCFF base, your general funds at the bottom, all the way up to Title III, which is highly restrictive and has a number of requirements attached. So what we squished in here this time were the Ed Relief funds. And as you can see, we've placed them between LCFF and your federal program funds. And that's because the use of Ed Relief funds is broader than our most categorical federal funds, but they still require adherence to federal requirements. So they're sort of in between there. Just to review on the next slide are the funds that we're talking about. And you can see they go back. There were three different funding sources, and they're based on three separate pieces of legislation from Congress. So the first was the CARES Act, which was enacted in 2020, and it was when the pandemic first hit. So that was the first bill that was passed. Next was the Coronavirus Response and Relief Supplemental Appropriations Act, CORISA, that followed that, and that one included similar requirements and similar allowable costs, but there were a few differences. And then finally was the American Rescue Plan, which is the latest of the three bills. So you can see these were all legislated by Congress. We talked about statutes and how they impact requirements for programs. And these are three statutes that are foundational to ESSER and GEAR funds. So you start first with the statute. What does the law say? These are the three laws. ESSER funds were included in all three bills and were allocated directly to LEAs based on their Title I student counts. Only ESSER and Gear 1 included an equitable services requirement for LEAs. And those of you who are around there might remember that created quite, to put it technically, a mess. As you recall, there was confusion over the equitable services, how that should be determined, which schools were served, what they could be used for. So fortunately, in the ESSER and Year 2, that was changed. And so now they put this responsibility for equitable services on the state. But if you have remaining ESSER and Gear funds that were reserved in that first year for equitable services, those needed to be spent for that, but nothing in the other two. So let's take a look at ESSER compared to other federal funds. CDE indicated, whoops, wrong one. First of all, they're not part of Every Student Succeeds Act. So that was number one. As we mentioned, there's separate legislation that passed by Congress that had separate requirements. And as we mentioned, they have a broader use of funds than most categorical programs. Most have a specific population that has to be served, specific, and that we talked about the intent and purpose is generally very much more specific. Title III, focus on English learners, immigrant students. Title II, professional development. These funds were a lot more broad than those were. Activities, though supported with those funds, all had to meet the basic purpose of being in response to COVID. And that was an important criteria, and that kind of got lost in some cases as people were looking at spending the funds. They had to include specific requirements and allowable uses, and the CDE website had a whole list of allowable uses for these funds. Because these are federal funds, however, they are subject to the Code of Federal Regulations or the Uniform Guidance, which is what we've been talking about for the last couple of days. It hasn't been that long since yesterday that we talked about. Initially, there was an impression that these funds were not subject to any requirements and fiscal oversight, which has led to a number of LEA compliance findings recently. In addition to the legislation and the statute that implemented these programs that has requirements attached to it, GEAR funds were allocated to the governors, and the governor added conditions. So there are also state requirements associated with the GEAR funds. So they're even more complex. And we said the state can add more. In this case, in some cases, they combine state and the funds with the GEAR funds and pulled them together. And so both requirements applied. So this is kind of the similarities and differences. Again, not part of ESSA, but they are federal money, and that triggers the Uniform Guidance or the Code of Federal Regulations. However, when the funds went out to districts, we kind of, what we saw, this is what seemed to happen. First of all, ESSA and other categorical funds, they go to the state and federal people, right? They know, nobody wants to deal with that. They've got all those rules, send them over to the state and federal people. They know all the rules. So people sort of count on you to be for oversight of that and to make sure they're used in a compliant manner. Ed relief funds, however, because of that broad use, went typically over to the fiscal office. And the fiscal office, in many cases, is not used to applying all the rules that go with federal programs. They deal with a lot of the state funds and bigger chunks of money. And what happened was a communication gap in a lot of places that the state and federal people might have had an idea of some of those requirements that needed to be implemented, and that maybe the fiscal office weren't aware of. So what happened? We've had misunderstandings about things like expenditure timelines. I can't tell you how many districts I'm talking to who are finding that ESSER funds, the fiscal office was keeping their eye on the timeline for spending those ESSER funds, and that was their focus. And as a result, they picked up some of those ESSA, particularly Title I funds expenditures, because they kind of fit. They were broad enough. They picked them up with the ESSER funds, and those then resulted in significant carryover issues for some of our districts with Title I, because the things they had planned to be spending it on were picked up by the ed relief funds. So that was one thing that we've seen happen. The other is that the compliance requirements associated with the federal funds are resulting in compliance and audit findings now that we're seeing. And you can see on the next page, the federal stimulus monitoring instrument includes a review of all the things on this page, which should look kind of familiar to you after yesterday. Time and effort reporting, internal controls, cash management, procurement, all of this is reviewed within the program instrument. And as you can see, not every LEA was prepared for that and didn't have that documentation. So we're seeing this pop up in reviews. The next slide shows a CDE's overview of some of the top items that are finding non-compliant for the ESSER and GEAR funds. And you can see number one is procurement. And that's likely because these were used for capital expenditures, significant amounts of equipment that was purchased, and these fall under the bid requirements. So in many cases, districts weren't following their own procedures and policies for going to bid and weren't following the legal requirements for those purchases. Time and effort also from the beginning, CDE said, we're really encouraging you to keep time and effort reports, but that was another key finding. The other was equipment management, keeping track of that equipment as you do with your ESSA funded programs. That wasn't happening. And so that was another big finding. So just kind of a heads up, these are things. And now CDE has, they have pulled back on the fiscal monitoring to focus now more on more districts for ed relief fund monitoring, because they're seeing that's where the problems are. So just wanted to put that on your radar. You're the people who know all about the requirements, the Code of Federal Regulations about time and effort, property management. So hopefully your district will start leaning on you for that expertise to support them. The next slide just gives you, if you want just a quick summary of all the programs. This is on the CDU website, and it's got all the COVID relief funding, and it's a nice little synopsis of both state and federal funds that were allocated for COVID relief. So just a resource for you there. And just to kind of bring it to a close, this is a slide that we shared a long time ago when these funds started to be released. And as you can see, at that time, CDE was saying that the funds would be audited. Not sure if people believed it, but it was way out there. They also said they were going to fall under the Uniform Grants Guidance, and that internal controls and time and effort reporting should be in place for the COVID funds. And that they mentioned that might look a little different under COVID time and effort reporting. Remember, they recommended that you might have something for extenuating circumstances, or that might be in there because your time and effort reporting might have looked different when people weren't in schools, but you needed to have something that addressed it in your policies and procedures. And then they emphasized the importance of documentation and keeping records about decision making, because the use of these funds is so broad. The question is, and many times, going to go back to, why did you decide to do this? What triggered it? And how is this connected to COVID? So the decision-making process, and they say keep contemporaneous documentation of that decision-making process to show why and how you made those decisions. So just a surprise, just a little review on that, and it's something that's kind of coming to light now. That comes to the And I think we've tried to answer some questions in the chat, but we're here if you have additional questions. And please let us know if there are other topics we can be helpful with. But we've really appreciated getting to see your names and connect with you, and have enjoyed the last couple of days with you. So best wishes to you on the start of a wonderful school year. Take care of yourselves. Thank you.